Hello, welcome to Capital Sensei. Today we're going to dive into a source of wisdom that might surprise you when it comes to money, wealth, and investing, the Bible. We'll be looking at 10 proven financial lessons from this ancient text, not from a religious standpoint, but through the lens of an economist and investor. We'll cover everything from the dangers of debt and the power of saving, to the surprisingly modern concept of asset diversification and the importance of a long-term mindset. Whenever we can, we answer questions in the comments. Financial journeys are personal, and the principles we discuss today might resonate with you in different ways. So please, feel free to share your own stories, ask questions about how these concepts apply to your life, or offer your own insights. Building a community that learns together is one of the best investments we can all make. Let's start with one of the most direct and powerful financial statements you can find. Proverbs chapter 22, verse 7 says, "The rich rule over the poor, and the borrower is slave to the lender." Now, from an economic perspective, this is a profound statement about the nature of debt. When you borrow money, you are essentially selling a piece of your future freedom. You are committing your future labor, your future earnings, to pay back not only what you borrowed, but also an additional amount in interest. Think of it this way. Debt is like being a rower on someone else's ship. You are providing the energy, the power, the sweat to move the vessel forward, but the lender is the one at the helm, steering the ship. They set the terms. Your work primarily benefits them until the debt is fully repaid. This loss of autonomy is what the verse means by being a slave. You have fewer choices. Your income isn't entirely your own. A portion is already claimed by someone else. Now, not all debt is created equal in the world of finance. We often talk about good debt versus bad debt. Good debt is typically leverage used to acquire an asset that will appreciate in value or generate income, like a mortgage on a home or a loan to start a business. Bad debt, on the other hand, is usually high-interest consumer debt used for depreciating assets or consumption, like credit card debt for a vacation or a new television. The Bible's warning is especially potent for this latter category, where you become enslaved to pay for a memory or an object that is losing value every single day. The core economic principle here is the cost of capital. The interest rate is the lender's price for taking a risk on you. The higher the risk they perceive, the higher the interest rate. When you're shackled by high-interest debt, compound interest, the same force that can build fortunes, works fiercely against you. Each month, the interest capitalizes, meaning you start paying interest on the interest. It's a vicious cycle that can feel impossible to escape, perfectly illustrating that ancient concept of servitude. Our second lesson shifts from what we owe to what we do. Proverbs chapter 14, verse 23 states, "All hard work brings a profit, but mere talk leads only to poverty." This is a fundamental concept of economics, the creation of value. Your single greatest financial asset, especially when you're starting out, is what economists call your human capital. It's your ability, your skills, your knowledge, and your capacity to work and produce something of value. Mere talk is the equivalent of a business plan with no execution. It's an idea with no action. In economic terms, an idea has no tangible value until it's implemented. You can have the most brilliant investment thesis or business concept in the world, but if you don't act on it, if you don't put in the hard work, it generates zero profit. Wealth is not created in a vacuum. It's the result of applying labor and intellect to resources to produce a good or a service that someone else finds valuable enough to pay for. Think of a farmer who spends all day talking about the amazing crops he's going to grow, the market prices he expects, and the beautiful weather he hopes for, will end up with an empty field. His talk leads to poverty. The farmer who goes out, tills the soil, plants the seeds, weeds the field, and brings the harvest to market is the one who profits. Diligence is the key. In your own career, this means continuously improving your skills, being reliable, and demonstrating productivity. That's how your human capital grows, leading to higher wages and more opportunities. This leads us directly to our third lesson, the bedrock of all wealth accumulation, saving and planning ahead. Proverbs chapter 6 gives us the famous parable of the ant. It says, "Go to the ant, you sluggard, consider its ways and be wise. It has no commander, no overseer or ruler, yet it stores its provisions in summer and gathers its food at harvest." This isn't just a cute story. It's a sophisticated model for managing economic cycles. The ant understands that life has seasons. There's a summer of plenty when resources are abundant. In our lives, this could be our peak earning years, a booming economy, or a period of stable employment. The ant diligently works during this time, not just for its immediate needs, but to store up provisions for the winter, a time of scarcity. The winter could be a recession, a job loss, an unexpected medical emergency, or retirement. The fool, as another proverb points out, gulps down everything they have. They live paycheck to paycheck, consuming 100% of their income. The wise person, like the ant, saves. This is the principle of paying yourself first. Before you pay your bills, before you buy your groceries, you allocate a portion of your income to savings. This stored provision becomes your emergency fund, your investment capital, and your retirement nest egg. It's what allows compound interest to begin working for you instead of against you. Without savings, you are perpetually vulnerable. Any small disruption can become a major crisis, forcing you into debt and putting you right back into the servitude we talked about in the first lesson. The ant's wisdom is about creating a buffer, a margin of safety that gives you stability and options, regardless of the economic season you find yourself in. It's the proactive management of your personal balance sheet. So, you've started saving. Now what do you do with that capital? This brings us to our fourth lesson, a principle that is the cornerstone of modern portfolio theory: diversification. Ecclesiastes chapter 11, verse 2 advises, "Give portions to 7, yes to 8, for you do not know what disaster may come upon the land." This is, without a doubt, the ancient world's version of don't put all your eggs in one basket. Think about that instruction. Give portions to 7, yes to 8. It's incredibly specific. It's not just about not putting everything in one place. It's about actively spreading your capital across multiple different ventures. In modern investment terms, this is called asset allocation. The disaster that may come upon the land is risk. It could be a market crash, a sector collapse, a company going bankrupt, or a real estate downturn. You cannot predict these events with certainty. Imagine you're an investor and you put all your money into one single company's stock. If that company soars, you do fantastically well. But if that company is, say, Enron in the year 2000, you lose everything. You are completely exposed to the specific risk of that one company. By spreading your investment across 7 or 8, or in modern terms, across different stocks, bonds, real estate, and maybe even commodities, you insulate yourself. The key here is that these different assets should ideally be non-correlated. That's a bit of jargon, but it just means they don't all move in the same direction at the same time. When the stock market is down, maybe your bonds are stable or even up. When real estate in one country is struggling, perhaps international stocks are doing well. This is how you build a resilient portfolio that can weather unforeseen disasters. You're not trying to eliminate risk, that's impossible, but to manage it intelligently so that a single point of failure doesn't wipe you out. Of course, figuring out how to diversify and which assets to choose can be complex. That leads us to the fifth lesson, the value of seeking counsel. Proverbs chapter 15, verse 22 is crystal clear. Plans fail for lack of counsel, but with many advisors, they succeed. In a world saturated with information, it's tempting to think we can figure it all out on our own. But this verse champions the wisdom of collaboration and expert advice. Making financial plans in a vacuum is incredibly risky. You are limited by your own knowledge, your own experiences, and your own biases. We all have blind spots. Seeking counsel from many advisors is a risk mitigation strategy. This doesn't necessarily mean hiring a whole team of expensive consultants. It can mean talking to a certified financial planner, consulting an accountant at tax time, or having a lawyer review your estate plan. It also means reading books by respected investors and learning from the successes and failures of others. Think of building a house. You might have a great vision for what you want, but you would still hire an architect to draw up the blueprints and an engineer to ensure the structural integrity. Why? Because they have specialized knowledge that you don't. They can see potential problems, a weak foundation, a poor layout that you would completely miss. Your financial life is the house you're building for your future. Trying to do it all yourself without counsel is like trying to pour the foundation without checking if the ground is stable. This principle protects you from your own ignorance. A good advisor can challenge your assumptions, present you with options you didn't know existed, and help you avoid common pitfalls. The cost of good advice is almost always less than the cost of a major financial mistake made in isolation. Your plan is simply more robust, more resilient, and more likely to succeed when it has been vetted by others with relevant expertise. Now, while we're on the subject of avoiding pitfalls, let's tackle our sixth lesson, the danger of get-rich-quick schemes. Proverbs chapter 13, verse 11 says, "Dishonest money dwindles away, but whoever gathers money little by little makes it grow." This is a timeless warning against the seductive allure of easy money. It contrasts two methods of wealth creation, the fast and flimsy versus the slow and steady. Dishonest money, here, can be interpreted broadly. It can mean money from scams and fraud, but it also applies to speculative frenzies and highly risky ventures that promise astronomical returns overnight. Think about cryptocurrency scams, penny stock pump and dumps, or multi-level marketing schemes that rely on recruitment over product sales. These things often seem too good to be true, because they are. The money that comes from them, if any, often dwindles away just as quickly, because it's built on a foundation of sand, not real value. The second part of the verse gives us the alternative. Whoever gathers money little by little makes it grow. This is the philosophy of the long-term investor. It's the ant from our earlier lesson. It's the magic of consistent saving and disciplined investing, allowing compound interest to work its slow, powerful magic over decades. Building real, sustainable wealth is a marathon, not a sprint. It's about buying valuable assets and holding them, reinvesting the dividends, and letting time do the heavy lifting. In finance, there's an unbreakable law. Risk and return are related. If someone offers you a very high potential return, they are, whether they admit it or not, also asking you to take on a very high level of risk. The desire to get rich quickly often clouds judgment, causing people to ignore this fundamental law. They take on massive, uncalculated risks, and as Proverbs 28 warns, are unaware that poverty awaits them. The slow, methodical path isn't glamorous, but it is the one that has been proven to build lasting wealth. This brings us to a lesson that may seem counterintuitive from a purely financial perspective: the principle of generosity. Proverbs chapter 11 verse 24 presents a paradox. One person gives freely, yet gains even more. Another withholds unduly, but comes to poverty. How can giving money away possibly lead to gaining more? From a sterile economic spreadsheet view, it makes no sense. An expense is an expense, but finance is not just about numbers. It's also about human behavior and psychology. First, generosity can fundamentally change your relationship with money. When you hold onto every penny with a clenched fist, when you withhold unduly, money owns you. It creates a mindset of scarcity and fear. Generosity, on the other hand, fosters a mindset of abundance. It helps you see money as a tool to be used for good, not a treasure to be hoarded. This healthier mindset can lead to better, less fear-driven financial decisions. Second, on a more practical level, generosity builds what economists call social capital. Your reputation, your relationships, and the trust you build within your community are intangible assets, but they have real economic value. A generous person is often seen as trustworthy and respectable. This can lead to unforeseen business opportunities, partnerships, and a strong support network that can help you in times of trouble. Think of it as investing in your community and your relationships. The returns aren't always immediate or direct, but they are real. The verse from Luke chapter 6, "Give, and it will be given to you," reinforces this idea of circulation. A healthy economy and a healthy personal financial life involves flow. Money that is hoarded stagnates. Money that circulates through spending, investing, and giving creates activity and opportunity. Generosity is part of that healthy flow. It prevents the psychological disease of greed and builds a rich life in ways that go far beyond a bank statement. As you build wealth, the focus naturally shifts to the long term. This is our 8th lesson: the importance of leaving an inheritance. Proverbs chapter 13, verse 22 says, "A good person leaves an inheritance for their children's children." This is not just about passing on money. It's about adopting a multi-generational time horizon for your financial planning. This is a profound shift in perspective. Most people plan for their own retirement, which might have a 20 or 30-year horizon. This verse challenges you to think beyond your own lifespan. Children's children means you should be making financial decisions today that will still be bearing fruit 40, 60, or even 80 years from now. This forces you to focus on truly long-term, sustainable strategies. You're not just building wealth for yourself, you're building a legacy. This involves very practical steps. It means having a will or a trust. It means considering things like life insurance. It means choosing investments that are designed for long-term, stable growth rather than short-term speculative gains. But perhaps most importantly, it means passing on financial wisdom, not just financial assets. An inheritance of money given to children who have not been taught how to manage it is often squandered quickly. The greatest inheritance you can leave is financial literacy. Thinking in multi-generational terms also changes how you view your assets. A family home is not just a place to live. It's a potential asset for the next generation. A successful business is not just a source of income, it's a legacy that could provide for your grandchildren. This long-term view encourages prudence, responsibility, and a focus on building things that last. Now, for a very specific, tactical piece of advice that is surprisingly common in the book of Proverbs. This is our 9th lesson: the trap of cosigning loans for others, or what the Bible calls surety. Proverbs chapter 22, verses 26 and 27 warns, "Do not be one who shakes hands in a pledge or puts up security for debts. If you lack the means to pay, your very bed will be snatched from under you." From a modern financial standpoint, this is an incredibly savvy warning. When you co-sign a loan for someone, whether it's for a car, an apartment, or a personal loan, you are not just being a helpful friend. You are becoming 100% legally responsible for the entire debt if the primary borrower fails to pay. The bank now sees you and the borrower as the same entity. If they miss a payment, it damages your credit score. If they default entirely, the lender will come after you for the full amount. Think about the risk-reward profile of this transaction. What is your potential upside? Zero. You get none of the benefit of the loan. You don't get the car or the apartment. What is your potential downside? 100% of the loan amount, plus interest, plus damage to your own financial reputation. You are taking on massive, uncompensated risk. It's one of the worst financial arrangements you can enter into. The Bible's language is stark. Your very bed will be snatched from under you. This isn't an exaggeration. If you can't cover the debt you co-signed for, lenders can and will pursue your assets to get their money back. This single act of misguided kindness can unravel years of your own careful financial planning, diligent work, and saving. It's a reminder that good intentions don't negate bad financial contracts. Protect your own financial house first. Finally, we arrive at our 10th and perhaps most profound lesson, which underpins all the others: the wisdom of contentment. 1 Timothy chapter 6, verses 6 through 10 contains the famous line, "For the love of money is a root of all kinds of evil." But the context is key. Godliness with contentment is great gain. The goal isn't just to be godly. The great gain comes from the combination with contentment. In economics and psychology, there's a concept called the hedonic treadmill. It describes our tendency as humans to adapt to new circumstances, whether good or bad, and return to a baseline level of happiness. You get a big raise and you're euphoric for a few weeks, but soon that new salary becomes your new normal and you start wanting more. You buy a bigger house and it's exciting at first, but soon it's just your house. You're always chasing the next thing to get that temporary happiness boost. Contentment is the act of stepping off this treadmill. It's the ability to say, "I have enough." This is not an argument for laziness or a lack of ambition. It's an argument against the endless, joyless pursuit of more for its own sake. When you're content, you can make financial decisions from a place of logic and peace, not from a place of greed, envy, or fear. Greed makes you chase get-rich-quick schemes. Fear makes you panic sell at the bottom of a market crash. Envy makes you take on debt to buy things you can't afford just to keep up with your neighbors. Contentment is the psychological anchor that allows you to stick to your long-term financial plan. It lets you save diligently, invest patiently, give generously, and avoid foolish risks, because your happiness isn't tied to the next dollar. It's the mental foundation upon which a truly wealthy life, one of financial freedom and peace of mind, is built. It is truly great gain.